This week, we talked to two experts, not one, but two, with regard to consulting and what to do with the background regarding both personal finance and sales and advertising. Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money. What we're going to do is we're going to look at how people might react with regard to market volatility. So think about what you can do. What kind of tips can you consider? What will you do if markets get volatile? And what sorts of things could you put in place today to make sure that you can act properly down the road? This week, we have two guests, something that we haven't done before in Make Better Wealth Decisions. And they're both guests that have appeared before in a previous podcast that was rebranded differently. They're the principals of a firm called Strategically, which is a bespoke consulting firm that helps global decision makers with data and insights. Those two people are Nadine Livingston. Nadine is the CEO and founder. She's got 30 years of experience in marketing and advertising. And Pat Dunwoody. Pat is the co-founder and chief strategy officer, and she's got 30 years of experience in the financial services industry. How are you today?
Great, thanks. Good, thank you.
Good. I wonder if we can begin by talking about something that a lot of people are talking about in the summer of 2024, and that's volatility. There's been varying degrees of volatility over the past week or two. And I'm wondering, Pat, let's begin with you. Your thoughts about volatility in general in the current context in terms of how would you say people are reacting?
Much better than they did in the 80s. The 80s, they just sold and crystallized their loss. So I'm glad people aren't doing that. Listen, market volatility is just a sign of the times. I mean, that's what happens in the market. Quite often, it's not natural. Things are, people are playing with the market. So as long as you don't need the money today or tomorrow, we used to say just don't open your statements, but now it's really just don't look at the price of or the valuation of your portfolio. Ride through it because the term of volatility, they really aren't that long. So you can ride through it before you need the money and it always comes out higher. So I would say, depending on how well you accept and can live with volatility, it's not a perfect term, but there's a term in the fund industry. It's called standard deviation, and they use that to measure how volatile a product is. So if you know yourself, you can't handle volatility, that just makes your stomach grind, go for a low number. And I'm not saying that you will make more money or less money, but you will be able to sleep at night. So
Right.
this is just part of normal investing.
So then, Nadine, Pat's the finance person in the consulting firm, and you're the marketing and strategy person and the person who helps people think about how they can sell things. What is your take on the way the financial services industry spins volatility? When people start talking about it, how do salespeople think about it? And do they think of it in terms of just minimizing it or telling people to live with it? Or what do they say?
I think from a few different perspectives, if you look at financial advisors, they're smart in helping their clients come up with strategies to weather the storm. Whereas marketers, if you're selling a product or you're in that industry where you need to make a sale and you're even financial news, you've got those big headlines that freak people out because then that's going to create attraction. You're going to get more engagement on your paper because you've got, oh my gosh, volatility, like the Canada's going to crash. So I think from a marketer's perspective, especially in financial services, I think it's really important for any company or stock or anything like that just to be very transparent about what their plans are, what their strategy is, what their plans are, how they're going to mitigate any kind of risks if there is a potential crash. And a lot of them, if they do weather the storm, it's short term. It's never something that lasts 10, 20, 30 years. Excuse
Well,
me.
that's exactly where I was going to follow up with you. People say it's fine, you can handle it and so forth. But I wanted to delve a little bit deeper in terms of what you might reasonably expect. A, if the drop is more severe than you expected, or B, if it is more prolonged than you expected. And I think it's the prolonged part that I wouldn't mind getting your thoughts about, because if you say, oh, it'll be over soon without defining soon, and someone thinks soon means by the end of the quarter or by the end of the year, and in fact, 2, 3, 4, or more years go by and you still haven't recovered where you were previously, what do people say to keep investors sticking with the program?
I think Pat again has a slightly different answer than mine, but I think we're on the same page because we want to be positive and have that outlook as, hey, listen, it's not like we're going to be in Armageddon in the next couple of years or anything like that. So I think it's very important to be transparent again. And sorry, Pat, I took that off you. So go ahead.
I'm agreeing with Nadine. Unless there's World War III, nothing's going to happen that will last. And again, I'm not the expert, but more than 3 years. Like nothing's lasted that long, even the 80s and 2008 drop. So
Well, wait,
I
wait,
would
can I push
say
back? Can I push back on that?
it
Yeah, the
took a while
Japanese
to come
market
back.
hit a high at the end of 1989, and it didn't regain a new high until earlier in 2024. It was over a third of a century, depending on where you're keeping score. But back in the late 1980s, Japan was the second largest stock market in the world.
Okay. I'm talking Canada.
Okay.
Canada. Because I mean, because the investors there too in Japan, they don't really have interest rates either, right? Like
Right.
it's the very different mentality of investing. But here, to your point, John, I don't think that the size of the drop is near as important as the length of it.
Right.
Because everybody, with the assumption that people are working with an expert, hopefully,
Mhm.
they've planned out their exit.
Mhm.
So if I'm investing, if I'm only 20 and I'm investing for 40 years, I shouldn't have to worry about anything. It's going to run its course and hopefully be able to invest when the market's down. If I
Right.
am close to retirement or at retirement, again, if I've been working with an expert, I should be positioned sufficiently so that I don't have to touch my equity stocks and I've got some cash that I can use until the market comes back. If I'm in retirement, again, it's not like I have to pull all my money out when the market's down. Oh my God, I'm going to lose hundreds of thousands. I choose one stock that may not have dropped as much or one specific that's recommended, and I use that.
And if
So
you have some
again,
income, you can sell the income, right? And if you need,
exactly,
if you've got to
exactly.
make a RIP
So
withdrawal.
again, just I'm hoping that you're positioning yourself with always that in the back of your mind that
Right.
and
Sure.
I assume we'll talk about that. But if something happens, I can get by until the market recovers.
So, what I think of is the old quote from Mike Tyson. I think the two of you might both be familiar with it, and that is, "Everyone has a plan until someone gets punched in the face." And similarly, everyone's got a plan about how they're going to weather a market downturn, and it's great. And the difference between theory and practice is that in theory there's no difference, but in practice there is. And people say, "Oh, I can handle this," but a lot of people don't even know themselves. They don't even know what they themselves can handle. I'll go back to you, Nadine, from a marketing perspective, from a sales perspective. Pat will give the standard financial advice viewpoint. But if you were trying to, let's say you're representing a company that manufactures an investment product and you're using the advisor as the intermediary, what can people who are marketing those sorts of products say or do to help people to remain calm and to stay the course and to not get too jittery?
I think it goes back to what I said earlier about making sure that there is a plan. First of all, there's a strategy, there's a plan, but be able to tell clients and customers at the end of the day everything that you're doing to mitigate various risks. So there is something that I think we've all talked about at some point in the military. It's referred to as tabletop exercises. So what
Mhm.
they do is they will look at every worst case scenario possible, and then what they'll do is everyone will have an activity against that so that they can mitigate all of those potential risks. So in the financial services world, I know that they do the exact same thing. Every industry does it. We started in elementary school when we're practicing for fire drills. If there's a fire, What are all the exits? If there's a
Right.
stranger, if there's this or that. So we're very risk adverse, I think, as a community when it comes to Canada. And then again, doesn't matter the industry, but I think as long as we're clear, we're transparent, and we're going to get that brand loyalty because we'll gain customer trust and retention just because of the fact that we've shown them that we can mitigate all of those risks that we can definitely weather the storm when it comes to market volatility.
So you mentioned fire drills a moment ago. And it's funny because I've been in my line of work for as long as the two of you were each in your respective careers before starting strategically. And one of the things that we used to do at one of the firms I was at was something called a lifeboat drill, which is the idea of if your boat hits an iceberg, we've all
Right.
got to get ourselves to the lifeboats and make sure that we can do things fine. Another phrase that has been used, I don't know if the two of you know who Daniel Kahneman is, but he's a Nobel laureate from 2002, and he won his Nobel with his research partner Amos Tversky with regard to something called prospect theory, and specifically loss aversion. And so what he says that you should be doing is something called a pre-mortem. So you know what a post-mortem is? When someone dies and they call in the coroner to figure out what it is that caused the person to die and to make sure there was no foul play and that sort of thing. A pre-mortem is when you say, okay, let's play a game of imagine the future where you imagine something bad has already happened.
Right.
And then you have to think about, well, what would you do today if you knew this was going to happen? And of course, no one knows what's going to happen. But in order to get a better handle on how you might react, you actually ask people to gamify their own reaction and you give them a specific number. So let's say you've got $1 million portfolio, it's 70% in stocks and 30% in bonds. And now we have a 50% drop. And now bonds have stayed flat. And now your portfolio is worth 650,000 because your 700,000 in stocks is worth 350. How would you react? What would you do? And then you ask people, what would you do? So seriously, what do either of you have any comments about that sort of a pre-commitment to behavior, a pre-exploration of what that behavior might look like, and hopefully finding ways to develop some hacks to mitigate anything that might be harmful if it were to come to pass?
Certainly, that's part of the whole know your client procedure that advisors have to do when they first have the client and then ongoing to make sure if anything happens in their life, if that view changes. But that's the whole scenario of the what if scenarios, similar to what Nadine talked about, that you always used to get the question, can you afford to lose 10,000 or 100,000? It's an easy question to answer because it hasn't happened. So until it happens, your gut isn't going to react the way it should. So one, if you know you're risk adverse, then you have to be in a less risky portfolio. And yes, you're going to miss some of the upside of portfolios out stock market gain, but you're going to sleep at night and you'll still do well. So I like pre-mortem. It probably is a better than the what if scenario because you really are talking a realistic thing. What happens if the market goes down by 30% and stays down for a year?
Yeah,
And so maybe the answer is then, you know what? Then let's take a portion of our portfolio and keep it in cash or really safe bonds because I may need money in the next 3 to 5 years and I don't want to crystallize any losses. But
sure.
it's a good conversation to happen. And I think it would be really good for an advisor to hear those answers because that will direct them into what products to invest in.
There's a concern that a lot of those conversations might not have been had lately because I think in the post-COVID world, a lot of people think they're bulletproof because if the market starts to get soft, people just think, oh, that's okay. Central banks and governments will just come running to the rescue like they did during COVID and everything will be fine. So Nadine, do people, again, you're the marketing person, do people properly contemplate outcomes that are less than ideal? Do you really think people have really given thoughts to what might actually happen?
Yes and no. I think for the most part, again, this is looking at it from my perspective, where let's say a bank, for example, as a client, they will give us the points that they want us to talk about on the marketing material. So
Mhm.
whatever the channel is, here we come up with a profile, persona, who we're targeting. or if it's an existing customer, then we know, or existing client, then we know what we're supposed to say, we're not supposed to say, because again, the bank gives us those talking points. Unless we personally know ourselves and we've got those relationships, like where we have that advantage with strategically, because we've got Pat, who's got that amazing experience and expertise, and a whole world full of financial advisors at her fingertips that she's built great relationships with. And then there's me, who's been on, I've worked with every one of the banks here in Canada and quite a few of them down in the US as well, but particularly in Canada. So I know only so much when I'm going to market things to clients. And I'm going off on a bit of a rabbit trail here, but you get the idea. Like, a financial advisor is going to have to, you hope that they're educating themselves before they educate, and they're not waiting to hear from every other financial advisor. You hope that they're going to do their homework. I think it's a great opportunity if perhaps if there was an association that did that, have those tabletop exercises, or there's those pre-mortems, and then you can see, okay, what are we really dealing with here? Is everybody just waiting for whatever to come hot off the press off of AI? Or are they really doing what they're supposed to do, their fiduciary duty as a financial advisor, to investigate all of the options and mitigate every possible risk?
Is it possible? I'm going to see if I can get the two of you to talk about this here. Is it possible, Nadine, that your people, the people that you talk to who oftentimes are represent banks or product manufacturers, the people who are always happy, are sometimes making life a bit difficult for the people that Pat is oftentimes working with, which is the ones who have to talk people down from the ledge when things, for whatever reason, are less happy? Do you think those two elements of the industry might be working at cross purposes from time to time?
I think that financial advisors are in a very difficult position because, again, they're getting all the fluff and the, hey, look, we've got this new product. Here's all
Right.
the benefits. We're not going to give them, these are all the possible risks with it. But if they read the fine print that's in 2-point font that somebody even with the Hubble telescope can't even read, then we're helping them out. But I think that, again, and Pat, like, cut in any time now, but I think that they're in a very difficult position because they have to, if they're a good advisor for their client, they have to mitigate all of those potential risks and make sure that they're informing their client of what all the potential risks are. In my case with financial advisors, I don't get that all the time.
Yeah.
So I have to do
So
my own homework.
So that's my concern is the industry, because I think a lot of professional ethical advisors want to offer a balanced approach, and risk and reward are related. And you don't want to be all doom and gloom, and you don't want to be all sunshine and rainbows, because sometimes things go well and sometimes they don't. And no one's exactly sure as to when one will end and the other will begin, or why, or for how long, or how severe it will be. It's just one day markets were going up and had been going up for 6 or 8 or 18 or 20 months. And then one day they stopped going up and then they started going down. And no one really knows how to really reliably figure out when that switch is going to take place. The people in the industry who manufacture products talk about a better tomorrow. That's what they do. They sell the aspirational view of, this is what I'm going to have. I'm going to be retired. I'm going to be sitting on a dock, sipping a margarita with my lovely spouse, and everything will be grand. Meanwhile, people come home from work and life happens, and dinner's going to be late, and the kids' soccer practice has been moved, and whatever else. And I don't want to put too fine a point out on this, but I want to go one more time. Do you think the industry, the people who manufacture products, who have to get you to feel good in order to buy their product, because no one's going to buy a product if it's a downer story, are perhaps overselling it, because that makes things difficult for those who are trying to be more balanced to actually be balanced?
That's a really good, no, it's a good question because I was in sales at one point and everything was good.
Yeah.
Our products were always better than the other products, right? Until the wholesaler moves to another firm and then, their head spins. I think what they have to rely on is what is in that portfolio. So as an investor, if I can look at the portfolio and I can see the company names, that will give me comfort that even in a time of volatility, those companies aren't going to go away. So the value will eventually come back. But if I just talk about the process and I can't see for some fund
Right.
products, I'm not able to see the full portfolio, it's a black hole. So
Right.
I think as a wholesaler, as somebody that's working for a product company, talk about what you're investing in. And that gives you comfort because Microsoft's not going to go bankrupt anytime soon. If you're investing in that, it may go down because everything goes down. But I think that gives a real sense of comfort to an investor if I know where my money is really ending up.
Okay. All right. So the two of you are starting what is effectively a startup. Your consulting firm is brand spanking new, 2024, and risk and return are related. And that gets me wondering if the two of you have any advice to give to listeners and viewers with regard to not being too high, not being too low, and keeping things on a fairly even keel and getting things done as they need to be done. So maybe one to do and one to avoid, like one thing that you really ought to be doing as you're starting a startup, and maybe another thing that you should definitely avoid. Maybe one from each of you on both.
You can go ahead, Pat.
Okay. So one, I would say try to do as much planning and organizing and structuring and work ahead of time before you leave your full-time job, because things never happen as quickly or in the timelines that you're expecting. So you want to have that buffer of money so that you can eat while you're starting a startup. So do as much as you can before you leave. I have two more, so I'm sorry, I'm going to take the positive is to really understand your strengths and weaknesses
Okay.
and be truthful. And so that when you are partnering with somebody or other people, that you're going to find people that have strengths where you have weaknesses, and then have rules. Sorry, Nadine, if this is going to be yours. We don't have many, but two specifically that we speak about all the time is that we only want to do projects that are good, quote unquote, with air brackets, is that are good for the world or good for people, good for the community. And we only want to work with people we like. We've
Right.
spent too much time in our career dealing with people we
Perfect.
don't like, and it's not wanting to.
Yeah.
All right,
Nadine?
Nadine, what do you have for a definite do and a definite don't?
Definite do. First of all, everything that Pat said is 100% definite do and definite don't. Um, you know, as far as capital is concerned, definitely make sure that you've got that and that you're allocating it. To Pat's point about the plan, make sure that you have marketing added in there. So don't, forgo a marketing budget and just focus on your product, and don't forgo, developing your product so that you spend it all on marketing. There definitely has to be a balance. So a good strategy and plan would help with that, and with the expertise as well. As far as, a definite do is, please do market research.
Good.
Definitely a definite must. Know your
Great.
market.
So now is with the point where we like to wrap up, and I always like to wrap up with we're here to make better wealth decisions. Nadine, I'll start with you. If you could recommend one thing, what would one thing be that you would recommend to help people make better wealth decisions?
Definitely speak with a very educated and obviously certified wealth professional. You can't do anything on your own, and don't just take their word for it, but definitely work with a legal professional when it comes to
Great.
tax advising and generational wealth building.
Great. Pat, what about you?
Yes, I agree with that. For those that are just starting out and you can't find an advisor that wants to take you and your $100 a month investing, there are still some really good online platforms that at least are going into some really good portfolios, and they have people that will answer your questions. So that's a great way of starting out if you don't have a lot of money.
I want to thank you both today because this has been a wonderful conversation, and it's an important topic because a lot of people always like to look just at the glass being half full, and sometimes it is glass half empty, and no one always knows when that's going to be. So thank you for your time today.
Thank you.
Thanks, John.
John DeGuy is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647 Stand Up. That's 647 782 6387 or at jdegui@designedsecurities.ca.